Hello everyone, I am Shyam Banka and welcome to this new video of management case study interview. Purpose of this video is to give you an understanding of how a management case study interview goes and what is expected of you in an interview. And for that reason, I am making a case study interview for all industries possible. So it's a very good habit for you to understand different perspective, different industries, and be confident whenever you go to an interview that whatever comes along, you'll be able to figure it out. This video is divided into two parts. In the first part, I'll be going through the interview and present my understanding of it. In the second part, I'll analyze the interview as a whole and present its overall structure. For context, all the black text with blue background, which you see is the statement of the interviewer, and all the blue text with a white background you see is the statement of the candidate. Today, we are doing a case study interview where our client is a textile retail, where our client is in textile retail industry. And let's see what he does. Your client is a leading textile company in India. Recently, it has been experiencing a decline in the return on capital. Can you analyze why? So, of the first statement said by the interview in a management case study interview is one of the most important because it tells you the scope of it and you try your best not to go out of the scope. So, we have information that our client is a leading textile company in India. They have been facing decline in its return on capital. Return on capital is nothing but profit, the money they have invested, and how much return they're getting on it, which is the profits. Could you analyze why? So this is a typical profitability interview, and a profitability case study interview is divided into three parts. In the first part, you try to analyze more of the client's business, its competition, what is the industry scenario as a whole. In the second part, you try to structure the situation and figure out where exactly is the problem coming from. And in the third part, you provide recommendations and solutions. So we are in the first part where we are trying to understand more of the client's business. I would like to begin by understanding more about the company and its products. What geography does it cater to? Could you please tell me about its product portfolio? The client sells different types of menswear and women's wear through retail outlets. The stores are spread out across India, mostly in tier 1 cities. Okay. All right. So that implies that the client buy clothes from wholesalers and sell it to consumers through retail outlets. Is that right? Is the decline related to particular store or region? Yes, the client procures from suppliers and sell it to final customers. The decline is across all stores in India. Okay, so this is also one of the very important question because it tells you where to focus on. So if the decline is that particular store, that means something in operations is wrong in that store. If the decline is at all the stores, that means in top management that there is some issue going on in the company structure. So it tells you where to focus on. So it's a pretty good question to ask. Noted. Do we have any information about the quantum of decline and since when it happened? Since there has been a 4% decline in the last year. Any other players in the industry facing the same issue? This is also important to understand if it's an industry-wide problem or just a client-specific problem. No, it seems to be a problem specific to a client's firm. Right. After, uh, right, are we considering the returns to just the equity shareholders or overall return to the firm? The decline is based on the overall long-term capital. Great. I would now like to dive into the case and structure it to get to the bottom of the problem. I will begin by breaking down return on capital into its component, operating profits and capital employed. Next, I will identify um, which of these are a problem and further look into the factors that may have changed to alter either of these. Would you like me to proceed in this way? So pretty well structured. So it the return of capital is divided into operating profits and what is the capital employed. So you're seeing how much you have employed and how much return you're getting, and then you'll look into both the factors. So this is also a very good adaptation done by candidate because usually if it's a profit question, you divide it into revenue and cost. But if it's a return on capital, you have a capital employed is nothing but the initial cost of establishing the firm, and then what is the operating profit you are getting, which is more in lines of the revenue of the company. Yes, that sounds like a good start. Why don't you go ahead? Since ROC is a function of profit and capital, I would like to know if the profits have decreased or the capital has increased or both. The capital employed by the firm has increased. Okay, so it's a more of a cost side issue. Okay, this implies that the firm is requiring more capital than last year to earn the same amount of operating profits. Am I correct? Yes, that is right. To analyze why more capital is being used to uh, generate the same profits, I would like to break down capital into its constituents. If we look at which assets are being financed, we can divide the capital into two parts: fixed capital and working capital. Fixed capital is permanently deployed capital in the business that would have been used to fund the land, building, machinery, and other such assets of long-term nature. On the other hand, working capital is used to meet the day-to-day operational cash requirements of the firm. Can we compare the balance sheets on as on date with last year to understand if one or both of these components have increased? So, pretty good summary. So, also, if you have not noticed, we have moved on to the second part of the interview at this statement where the candidate divided the situation, is trying to structure the situation to figure out the problem. And again, he has broken down uh, capital into its two parts. It's just fixed and working capital, and it's also he also tried to explain what could be the possible reasons, what could be the possible source of fixed capital, and what could be the possible source of working capital, and then asking the interview to go ahead with one of those. So it's a very well structured and well thought interview going on till now. That's a good idea. On comparing the two balance sheets, we find that the working capital invested in the business has increased. Right. Since working capital equals to current assets less current liability, we can further break down working capital by analyzing current assets and current liability separately. Current assets would include cash and bank, inventories, trade receivable, prepaid expenses, short-term investments, and advances. Uh, there can be other elements as well, but I'm assuming these are the major heads. If is that assumption valid? Yes, you may proceed. Great. Similarly, we can segregate current liabilities into trade payables, short-term loans, accrued employee bank, accrued expenses, bank overdrafts, and unearned revenues. The next step would be to find out if any of the constituents of the current assets or liabilities have seen a pronounced change from last year. Alternatively, multiple constituents might have changed in small amounts, resulting in a large aggregate change. Do we have numerical data that we can confirm either hypothesis? From the balance sheet, once again, we can say that the stark difference between the trade payables, we can see there is a stark difference between trade payables in the last 2 years. Eh, Okay. The working capital requirement have increased. Trade payables would have fall. Payables have to fall given the relationship defined earlier. Now we can look into possible reasons why the firm's creditors have decreased. Can I proceed with this approach? Yes, sure, go ahead. Some reasons why this might happen are as follows. First, the firm suppliers might have changed and a new supplier have allowed a smaller period of credit than the earlier ones. However, this would have possibly had an impact on the cost of goods sold as well as thereby the profits, unless the price levels between the suppliers are fairly similar. Second, the existing suppliers might have changed their credit terms, resulting in a shorter credit period and thereby lesser payables. Uh, have either of these events occurred? Not really. Are you aware how credit terms are framed in such contracts usually? Maybe that could help you pinpoint the issue. So it's a good hint given by the interviewer to look into how the credit terms are framed. From what I know, suppliers usually allow retailers a certain period, say 10 days, within which they have to make the payment for supplied goods. If the retailer makes the payment before that, he may be eligible for a cash discount, which is calculated usually as a percentage of purchase price. Correct. So, what might have happened here? The client may have changed his policy of payment to the suppliers. Earlier, the client would have been paying them the dues beyond the stipulated payment period. However, to avail the cash discount this year, the client could have reduced the credit period in all profitability. The benefit from the cash discount was outweighed by the increased working capital requirement as a result of the decrease in credit period from the supplier. So pretty interesting case and pretty tough to come to this conclusion, but the candidate was able to do it. All right, that makes sense. Let's wrap it up. Thank you. Thank you. That was a pleasure interacting with you. So what happened here was usually when you have uh, a payment time with a supplier and you pay before that, you get a discount on it. But because of that discount, the client had to increase his working capital, and that um, that increase in working capital requirement was outweighed the discount he got from the early payment. So that is what happened here, and that's why there was a decline in the return of capital. So uh, I hope you guys understood it, and we'll be moving to the second part of the interview where we will analyze the interview as a whole. So it's also very important to maintain very clear and straightforward interview notes, because sometimes at the end of the interviewer might ask for your notes and he should be able to understand everything in one glance. Interview notes. It is important to understand whether the cause of decline is due to profits or capital. Balance sheet structure and retail specific purchase contracts needs to be focused on. Decline is because of higher working capital requirements. Trade payables have reduced due to change in firm's policy towards supplier credit terms. Case facts. Leading textile company in India, retail decline in return on capital, 4% decline from last year. Um, Problem specific to the firm, not industry. Focus on overall return on capital, not equity. Capital employed by firm has increased. So this is one of the most important part of your notes, where you have structured the problem, which gives the interviewer an idea of how well in a structured way can you think. So the return on capital is divided into operating profits and total capital. We are told to focus here. It was divided into fixed capital and working capital. Fixed capital is divided into infrastructure and machineries, which and such other land, infrastructure, machinery costs. Working capital was divided into current assets and current liabilities. Current assets were divided into trade receivables, inventory, cash and bank and investments. And current liabilities were divided into current liabilities were divided into unearned revenue, trade payables, accrued expenses, and loans and overdraft. So I think it was pretty well structured, and the problem was coming from I think trade payables, loan and overdraft, inventories and investments. So I think everything was related, because we were not able to figure out problem from this issue, but the problem was as such that the client has taken, uh, increases working capital, which affected all of these, so that he could get a discount in this short-term payment. Okay, so what were the recommendations given by the candidate was shift back to the old policy to the uh, extended credit system rather than availing the cash discount. Another alternative is to negotiate with the suppliers in order to extend the period within which cash discount can be availed. Negotiate with the customer in order to reduce trade receivables or avoid selling before payment, zero debtor policy. This would free up some working capital. One of the observation suggestions for the interview was it is important to be aware of the different components that constitute capital. Textile industry specific knowledge could help to ascertain forms of contract and thereby reasons of the decline. So it was pretty well structured case study interview. Candidate was able to figure out the problem and come up with solution for it. And I hope you guys learned a lot from it. If you have a case study interview coming up, all the best for it. And if you're looking to build a career in consulting and want to understand different industries, do subscribe to the channel because I'll be uploading one video every day, which will give you an idea of how things are done in every industry, and which will really give you confidence when you go in a case study interview that whatever industry is put on you, you understand the for basic principles and you can think from first principles and solve any case possible. With that, I would like to thank you for watching the video till the end and hope you have a nice day.